I want to start, Zach, with the consumer. There's a story about Albertsons. The shares are just tanking today. And it's on my radar because Albertsons is saying that a softer consumer demand, in addition to a competitive environment, is hitting the company this quarter. And there's concern about that. We have higher oil prices, as we just heard from Charlie, diesel above $5 a gallon, gas above $4 a gallon. How is the Huntington Bank consumer doing?
What we're seeing actually is not that. We're seeing a lot of resilience and strength in the consumer franchise that we're seeing. Both spending activities continue to be very normal, borrowing activities continue to be very normal. And I think, partly what it probably is, Tim, is a little bit of that further evidence of a K-shaped economy. Our business is very much keyed toward the mass affluent and higher income segments of the consumer populace. And, in that group, we're still seeing strong employment, strong consumer spending, and fairly normal trends.
Just following up here, talk to us a little bit about your loan growth. I know that that's been an important category for your business. What does that tell you about specifically business clients and their plans for the future?
The pipelines that we have for loan growth as we think about the second half of the year are stronger today than they were 3 months ago when I was talking to you before. So we're seeing a continued acceleration actually in customer demand for borrowing, which is obviously a healthy sign for the economy generally. What's interesting is if you look at the results from the second quarter, of the 10 large regional banks in and around Huntington size, 8 of those 10 were growing loans annualized rate of between 9% and above, which is very fast, actually. And if you look back over the last 3 years, it is by far the fastest quarter of loan growth across the entire large banking sector. And so I think you're just seeing that kind of reflected not only in what I'm seeing on the ground for our own business, but broadly across the sector.
Your stock has tanked quite a bit today. We saw the decline in net interest margin that you reported. Talk to us a little bit about that, like us investors overreacting, or what is that we're seeing in the decline in the stock?
Sure. Well, look, spread revenue is just a little under 3/4 of our revenue. And so anytime there's a movement in the margin, investors react to that, and I understand it. I think, the thing that probably is being missed is that just as there's somewhat more competition around deposit costs, which have modestly reduced net interest margin, we're seeing the offsetting benefit in terms of higher fee revenues. Value-added fee services grew 30% year on year in the second quarter, and that's organically, not including any acquisitions. And of course, it's even faster given the partnerships that we've completed and integrated now. So we're seeing the opportunity to manage our revenues overall, and the guidance we've given for revenue growth in total is effectively unchanged. So from our perspective, the business performs exceptionally well. We're seeing a very strong second half of the year, albeit with a little different mix in terms of the revenues, Nina.
All right, so let's talk about the second half. I mean, what is your outlook, Zach, when it comes to interest rates and the impact it could have on you guys? Because we are increasingly talking about a higher rate environment here in the United States.
It's a big change, Carol, from what we had thought 6 months ago, right? We were just thinking about this internally a little bit earlier today. I mean, coming into this year, there were 6 rate reductions over the coming 6 quarters. Now there's the forecast for 2.5 rate increases baked into the curve. So, that's the kind of environment we're in now. It's a lot of choppy, volatile expectation. Our view is that we're going to have a higher for longer rate environment for at least the foreseeable future. And if there is a rate change, it is likely to be up. With that being said, I think we'll have to wait and see whether that actually comes to pass. I think we're all waiting with bated breath for what happens in September.
But that's a problem, the uncertainty. And we have a great column. My team knows I'm obsessed by Simon White about the most fundamental macro risk is back, and it is about specifically the volatility of inflation is also sharply rising again. And it impacts everything: goods prices, borrowing rates, Fed policy, and cash flows. It becomes more uncertain. I'm going
to send it to Zach on the terminal. Zach's on the terminal, so I'm just going to ID him the link, okay, in case he hasn't seen it yet.
Because people can't People can't make decisions. People won't take loans. Businesses, and so
this is hard. The new normal, Carol. I mean, this is the new normal that we're in right now at this point. I think.
But it's tough, right, for you and your clients.
It is hard. It does make it hard. There's no doubt about that. I think. Look, what is really encouraging is to see that in the macroeconomy generally, we have seen an extraordinary amount of resilience, notwithstanding this uncertainty. Go back to Liberation Day and the changes around potential, tariff policy. Then we have inflation and interest rate uncertainty as we came into this year, and then obviously geopolitical conflicts that bleed into lots of different elements of the economy. And notwithstanding all of that, you continue to see employment be strong, consumer spending be robust, corporate activity continue to be pretty strong. Obviously, there's a AI infrastructure investment super cycle going on that helps, but I think it's broader than that.
How does it? I'm just curious how that uncertainty affects your role. Like if you have to figure out, you have to make predictions about the future. You have to decide on how much to spend, where to open branches, who to hire, and how much to pay all these folks. Everything you just highlighted there is uncertainty. So how does that change the way that you think about the way that you deploy resources?
Look, we definitely need to be on our toes and more dynamic. The frequency with which we are looking at channel checking, what's happening in the environment, understanding really on the ground, what are we seeing right now so that we can pivot as we need to is heightened for sure. And I think, for us, the kind of the dynamic way that we manage the business, we're always, as a CFO, I'm always thinking about two sides of the coin. I want to invest as much as is possible to drive competitive differentiation, to drive sustainable long-term growth, but I also want to be able to modulate that. And in fact, we're doing both at the same time. Tim, I'll tell you, this year, for the last 7 years, we have re-engineered more than 1% of the cost base out of the company every year. This year is 1.6%. So we're doing more of that, and yet we're also investing more. The average investment rate, growth rate for the last 6 years has been 20%. This year is 32% more investments in technology, in marketing, in hiring new people. And so you've got to be doing both of those things. And I think, frankly, it's the companies that have the capability to manage dynamically in that way that really can continue to be successful and find the pockets of profitable growth in this, new normal of uncertainty.
Zach, you reported quarterly earnings today. There's a proposal out from the SEC to make that voluntary and to shift to semi-annual reporting. There was a comment period that ended earlier this month where a huge amount, as in 99% of respondents to the SEC, said that they don't think it's a good idea. Do you think you would change the frequency of your reporting if you were given the chance to?
I think that our key stakeholders, our investors, appreciate the frequency with which we are sharing information. I mean, frankly, Nina, we not only report every quarter, at the quarter end, but then at least once a quarter, if not twice, we're up on stage at a major conference talking about financial projections, talking about what we're seeing on the ground. And I think, investors have been accustomed to that and frankly value that. So, we'd be pretty reactive to what our stakeholders want, which I believe at this point is continue with that frequency of at least quarterly.
Okay, just one follow-up. You mentioned AI earlier. Big question amongst the CFOs that I'm speaking to for the CFO briefing is this question as to how do you keep a tab or lid on costs to make sure that AI spending for tokens doesn't go through your budget? How do you manage that at Huntington?
Yeah, it's a big area of focus. I will tell you at this point, we're still very much defaulted toward we want our teams to lean into, to quickly adopt this technology, and we want to see all of the innovation and promise of it first. With that being said, what I'm thinking about as a CFO, and as an aside, I co-lead with our Chief Technology Officer the company's AI efforts, and so I'm particularly close to this, is in the background, we are building a lot of infrastructure to be able to, in fact, manage token costs and optimize the cost of AI as we go forward. And a lot of that's going to come down to what's the best model for the right use case at the right time to be able to optimize that. I'm personally pretty sanguine here. From what we're seeing significant ROI at this, but albeit at the very early stages. We are just at the cusp of this revolution.
Zach, you're not saying to the guys down the hall, hey, get off of the AI, it's costing us money. Are you doing that?
It's funny you say that. We are celebrating usage. We are trying to encourage people to use it as much as we possibly can.